Good morning, everybody. Welcome to the Fro Show. Just to answer UK, you're saying, look at that picture. We are not the best looking team around the net. I don't know. I'd rather have experience over looks any day of the week, mate. But we need some. Those pictures have had some creative adjustments in anyway. So
I was going to say, I love your makeup.
Yeah. Anything to.
It's a great picture. And as AJ says, yeah, we are the wolf pack, mate.
Yeah, good name, like that one, the Wolf Pack. Yeah, we can. Dale's got his face and his Trading Warrior brothers. We can be the Wolf Pack. Yeah, I like that one. I can start getting that put in some of our marketing material. I think. Good call there, Alex. Right. Well,
Gavin,
here we are.
Andre looks menacing.
Very menacing. They all look menacing. Yeah, get a course or get a visit from Andre. Sending the heavy mob. Right, let's get cracking. Got quite a bit to get through. Right, where should we start? Let's start over in Japan. Get some data out the way first. A few bits and bobs going on there. Household spending, decent monthly number for March. Not so great on the year-on-year number there. Although not as crappy as expected. Again, March data, spending data, maybe not, maybe something that will be improving with all these wage rises. That's the hope from Kishida anyway. Current account numbers there. Kay, anything to take from those? They're always a bit up and down, aren't they?
As usual, data in Japan are largely ignored because it's not a bad current account, actually. It is not a bad one, but yeah. Those spending numbers, and again, we're still looking at the March data, yeah? And so I really think that the market is focusing on current fiscal year. So once we are going to see the April data, come on, Simon on the chat. Once we are going to see, I'm going to turn that chat off for the flow show. Once we see the April data, yeah, and April, May, then I think they may start to have like a bigger impact. The market, I think, has turned the page on the last fiscal year, and we are starting a new one, and those data will tell us more. But all in all, it's not a really bad picture, right? A 200 trillion yen positive number is pretty good. Is really actually pretty good.
Yeah, exactly. And I've just seen what you're looking at, Simon, doing his usual, taking the mick. Yeah, I called us the usual suspect last time I put that picture up, and he's having a dig at me now with the old Ming the Merciless. Oh dear, I'm going to ban him. Simon, you're banned. I'm going to get the ban hammer down. Anyway, moving on. Let's get on to some real work. UK numbers out this morning, and I'm going to make a point about these numbers as well. Quite a bit of data coming out. The main numbers being GDP, which for March was up 0.4%, beating expectations 0.1%, year on year up 0.7%. Slightly more importantly, though, we had the Q1 numbers coming in higher than expected at 0.6% versus 0.4% expected quarter on quarter, 0.2% year on year. So we are out of the technical recession, those green shoots. Growing a little bit taller than everyone expected. Decent data as well from industrial production and manufacturing production, but these numbers can be a bit hit and miss at times. Now that Q1, the first thing I want to say is that Q1 number is made me laugh this morning when it came out 0.6%. 19 hours before that number, the Bank of England came out with their forecast and expected Q1 growth at 0.4%. This was after they've had their Bernanke review. They couldn't even get that right when they probably knew what the date was going to be anyway, only 19 hours later. So their forecasting prowess has not improved just yet, missing out on those forecasts. But overall, decent data. We'll see if it gets maintained over the months ahead. We have seen a little bit of a softening in the services PMIs and some of the other data since we got all those green shoot numbers. Nothing huge, but where it sort of, I think services jumped up to 53 point something, and it's just started edging back a bit now. So yeah, maybe a bit of moderation in the months ahead. ECB's Ross said, yeah.
Wasn't one of Bernanke's recommendation to go for several scenarios? And they've already thrown that out of the window.
I don't think it matters how many darts they throw, Kay. They'll all miss the board anyway. So it's like that picture we like to put up now and again. Yeah. To be fair, they probably haven't put in place any new conditions after the review. They'll be reviewing the review and then reviewing what they review of the review before reviewing the reviews. So they'll probably announce something for the middle of next year when they're going to change forecasting or something.
Yeah, probably.
Yeah, who knows? But we'll get back to the BOE in a moment. ECB's de Guindos didn't want to commit on any path beyond June, so he doesn't want to be touting quick hikes straight after. He also said the ECB is not Fed dependent. Okay, well, in some aspects they are, so take that as you like. IFO was out with a bit of a survey picked up by the press saying that half of German construction firms are short of orders and they're not seeing the activity. So green shoots in Germany, particularly in the housing sector, don't look like they're going to get very high. Right, getting stuck into the BOE. So we got a 7-2 vote in the end to keep the bank rate unchanged, with Ramsden jumping across the line over to the cut side. As said, it was largely expected between that and 8-1. In fact, 8-1 would have probably been a bit of a disappointment. So he had to. I remember saying at the time when we had his comments that he'll be moving over to the cut side, who will look very stupid coming out with those comments and not doing so. So they voted, him and Dingle have now voted to cut rates by 25 pips. In the statement, said they had encouraging news on inflation, but need more evidence it will stay low before cutting rates. They're optimistic that things are moving in the right direction for a rate cut. The MPC will consider upcoming data and if these show a receding risk of inflation persistence. So the statement overall wasn't too far from the March one. I wasn't full of we're confident, more confident or anything. It was still pretty much sounding like they are still far away from a rate cut, but moving in the right direction. However, Bailey did his thing and kept the market on its toes a bit. He threw in some dovish comments, but overall we didn't get as dovish as the market expected, hence why we've seen the pound rallying in certain currencies anyway. So Bailey said that it's encouraging that inflation will be close to target in the coming months. So given their forecasting prowess, I don't know how he's coming around to that idea. We are going to see some drops in inflation due to the energy price cap cut as well. That kicked in April, so we won't see that until the next data. But he said, yeah, they're encouraged that inflation will be close to target in the coming months, but not yet at a point to cut the base rate. He says a June bank rate cut is not ruled out, but neither is it planned. He says that higher than expected wage and services inflation since February should give us pause for thought, but we should not over-interpret that. So they expect second round effects on domestic wages and prices to fade slightly faster than previously assumed. Those are the elements that have been keeping inflation sticky, according to them. Then said he went into a bit more of a dovish tone, said it's likely we will need to cut the bank rate over the coming quarters. Quarters could be next year by all accounts. It says it's possible we will need to cut rates more than currently priced into market rates, but rate cuts will really depend on how the data evolves. We have no preconceptions about how far and fast we will cut rates. One small cut in the bank rate would still leave us with restrictive monetary policy. And he also mentioned FX by saying on FX rates, different views on Fed and European interest rates is already largely priced in. BOE's Broadbent said he would look more closely at services inflation and wages over shorter periods of time. Now, Kay, not as dovish as the market wanted, but he still wanted to lob in. For all intents and purposes, they want to cut, and they want to cut as soon as possible. They're just not letting the data. The data's not good enough to cut, and I still fear they've got a little bit of nervousness about cutting too early. But they want to cut. That's beyond the shadow of a doubt, isn't it?
Yeah, I think so. You know what? The market was hoping for more dovishness, adding lines and stuff, but they didn't get whatever all that they wanted. So we saw the front running, right? We saw two full sessions of front running, sterling selling, in the hope that they would come out very, very dovish after what Ramsden and Bailey himself had said over the past week. So they didn't get it, needing to buy back the positions, or at least parts of it. And here we are. And I think a little bit, there is a chance for me that they go in June, because they are after both of the Fed and the ECB. So I think the door is open, but you may be right, and they are not going before. So we have the 20th of June, and then we are moving into the 1st of August. So your 1st of August may be spot on as well, but the door is open for June if in the meantime the data support it. I think they might actually go, even if we get after that better GDP. If we get lower inflation, they may go in June, because the door is open now. They voted 7-2, and then I've been thinking about, like, well, already yesterday, because we had like some weird call from one of the major banks, Citi, not to name them, who said that the vote could be 5-4. So I would have understood 6-3, didn't know where the fourth one would come from. But then James in our room said perhaps Broadbent. The way Broadbent spoke yesterday, he may be added to the list next time. And then if Bailey goes, there would still only be 5-4, unless Phil joins the picture, because he was very neutral last night, right? He went like both sides of the spectrum again, as many of them pleased to do now. So I think the door is open for June, but it's too early, far too early, of course, to start trading this. So we saw the gilt yields are, and actually since yesterday they have not reversed anything yet. I think let me quickly look. Yeah, they're starting to reverse, not reverse, but like just stabilize a bit. But they have been they've been sold quite a bit, those yields. So the bonds, the gilts being bought over the past 24 hours. So the market is clearly starting to price in June now, okay? But that doesn't mean, as I've already said so many times, that doesn't mean that the currency necessarily has to weaken a lot on the back of it. It's just we saw the weakening, and perhaps the gilt market is catching up a little bit on now. I'm going to be relatively neutral sterling right now on the back of the Bank of England and the combination of that GDP. Although I'm a little long sterling Swiss, just because I think the numbers are still good enough in the UK to hold a little bit of sterling.
Yeah, very much so, mate. And we keep saying it. We're in this situation, just because the market's coming around to June a bit more, where it was at August and September, doesn't mean the quid's going to sell off tons. Everyone knows that pretty much every central bank is heading towards rate cuts. It's just when, and you're not going to get huge moves on the when. When a bank goes from hiking to neutral, that's usually a big move. When a bank goes from neutral to a cut stance, that's a big move. But then when you're just dicing around when that cut's going to come, you're not going to get a huge move. So even though they may cut in June, and that's ahead of what a lot of the market has been thinking, it doesn't mean the pound's going to collapse 500 pips. And indeed, it hasn't. If we look, I'll look at the pound in a bit more. But this is that strange situation for me. It's could they, should they, will they? Could they and do they want to cut rates? Yes, absolutely. Should they cut rates? That's a different question. We've got 2 CPI reports to go before the next BOE meeting, so they're going to have plenty of data for that. You already know my suspicions that inflation can tend to be stickier over here than elsewhere, but they seem pretty confident about it. The other line that got me was the one that said that one small cut in the bank rate would still leave us with restrictive monetary policy. That sounds like if they're that desperate to cut, it'll be a little feeler cut, if you know what I mean. It won't be like, yeah, we're cutting in June and then cutting every other meeting, for the rest of the year. It'll be okay, we'll cut one and then we'll see how it goes type thing. So that's my only view, that they may cut in June.
Actually, Ryan, it would be a good thing if they can cut in with the economy doing all right, because that's going to boost a little bit. This could actually have an after an initial algo move, whatever, on the fact that they are cutting. This could actually be beneficial for sterling in the long run if they would. But if they would bring it over like that, and there, of course, you know my opinion about Bailey. He would mess it up big time. But I think it would actually be a pretty smart move to do here.
Yeah. So yeah, I mean, I'm still with August, but it wouldn't surprise me in the least if they cut in June, because that's the Bank of England. As we say, they're desperate to cut. If they get any chink of light to do so, then they will do. But I'll defer my changing my forecast until I see the data, because I can do that. I'm not a bank. As you said, BOE's Peel was up as well, talking on both sides of the fence. Says we don't yet have confidence inflation is subdued, and when we are more confident, we can start to reduce policy. Says they're restrictive, but not there yet. But then said we're thinking about moving rates over the next few meetings. So yeah, he was getting splinters with that comment. And as mentioned, the BOE have thrown into the mix talk on FX or policy divergence and its effect, because they added it into their statement that the increased divergence in demand across regions could be consistent with a divergence in monetary policy, with potential implications for exchange rates and broader financial conditions. So this is now all of them talking about it, Kay.
Conspiracy theory.
Yeah, was it on Facebook we were talking about this?
Yeah, and then later on in our chat room as well, we've been chatting about it in our Flowonomics room. It's it could be understood that there's just a few too many talking about this FX thing. I wouldn't go as far as saying that there's a bit of a tacit understanding that the dollar shouldn't strengthen further, but I for now I still think it's more the other central banks being scared what may happen to their currency if the Fed, as it now is becoming apparent, that they are going to wait longer than the rest of the central banks to start cutting, what it may do to the dollar. And yeah, it could indeed. So we were chatting about it, and we have to look at all possibilities. But I think it's a bit far sought that the Fed and the Treasury, because it's not only going to be the Fed, but I think the Treasury has to, because they are the ruler, right, of the FX stuff, and they produce all their programs and whatnot, reviews and so. I think it's a bit far sought to say like, oh, this is an agreement to stop the dollar from strengthening. But until we get there, and until we know exactly what's going to happen, there may be a bit of a conspiracy theory building around it. But again, I'm still siding on the side where I think it's a worry for the other central banks if they start cutting first, which they likely will, because ECB, everybody really says that June is there. BOE now opening the door. We don't know really for the rest, but it could be that SMB goes again as well, and they are, when are they? They're also on the 20th of June. Although the last blip in CPI probably or maybe doesn't warrant it. But everybody seems to be a bit worried about what could happen to the dollar. Now, is it a message to the Fed? Probably. Will the Fed and the Treasury have ears? I don't know. I really don't know.
Yeah, yeah. I mean, as we discussed yesterday, there's two lines of thought you could take from this. The line of thought that these central banks are having a little bit of a dig at the Fed, or giving the Fed a little prod to say, if you keep your rates up and we're cutting ours, the currency's the dollar's going to strengthen, which can be, as you call it, a bit of a wrecking ball. But then that's a bit. They can't really say that because they're the ones who are cutting rates and creating the divergence. It's not down to the Fed to control the level of currency for anyone, and it's more the euro weakening on an ECB cut than the dollar strengthening. So that I don't think they're doing that because they're all chums together. I think a lot, bar the BOJ, I think a lot of these banks, BOE, ECB, they're just front running their excuses why, if their currencies weaken and because it can bring inflation with it, that's what they're mainly worried about. Because obviously import goods, energy priced in dollars will cost more. That's going to bring inflation. So them cutting rates while the Fed stands still could actually bring them inflation. And then they're going to have egg on their face because inflation isn't going down as they wanted it to. So I think they're getting their excuses out early why inflation might go up, because then they can say, well, that's not our fault.
Yeah, but they feel the trap coming, and that's the thing. If they feel the trap coming, and then they're scared. And also, sorry, what I said yesterday in the room is we can't forget that there's a lot of dollar debt being added to when the Fed slashed. Well, they all slashed rates, but we know that the dollar is the biggest market. There's a lot of dollar debt added as well, and if those rates stay stickier than elsewhere, the costs are going up to refund those things, and they know that. They probably know the exact amounts. Well, they will, because they have the governments and stuff amounts. But and I think it's a bit of a global. I'm not going to say panic, but yeah, it is a bit of a message. But then I'll go back to what Yellen said at the start of the week, saying that like interventions are okay if they are really exceptional in exceptional situations. So that should tell us somewhere that, at least from the Treasury side, they are not ready yet to come up with an accord saying like we are going to stop the dollar from rising, not to weaken it, but we are going to stop it from rising, because I think the market is now making well, rightfully so, because we have to look at all possibilities, right? But I really think we are not there. Really not there where the Fed is going to say, or the Treasury will say, okay, guys, the dollar stops rising for now.
Yeah, very much so. And I'm going to do something awful, Kay. I'm going to put up the DXY chart. So, but I'm just don't sign off. I'm just doing it to show a point. If you want to take the dollar as a measure, or the DXY as a measure of the dollar, you got to look at context when you're talking about dollar strength or weakness. Okay, you could say it's looking a bit stronger than it has done over the last 20 years, but we've come through crises and pandemics and all sorts over this. It's not too far from historical averages. Okay, just draw a line through the middle there. It's not too far from an average. If we were up here 120s, then you could understand some of these central banks moaning, but we're not. We've been in this sort of range for a couple of years now, so there is no reason to be moaning about the currency at these levels. Take it down to its component parts. Let's go on to a clearer chart. There we go. So euro dollar, is it weak? We've been higher, we've been lower. Maybe it is a little bit weak, but given what it's done coming through all this inflation and rate hikes and rate cuts, we're not breaking any. We're not diverging now with these rate moves coming.
And take away inflation considerations, there is a growth difference between Europe and the US. It's as simple as that. There is a difference in growth.
Yeah.
the US economy is much more dynamic than the European one. And just coming back to this, the dynamism of the economies, also don't forget the other side will be through as well, because if things turn sour, the US could go a lot faster than Europe, for instance. Europe is traditionally, with all those many different countries, and is traditionally a slower mover. Okay, the pandemic has accelerated things, but is traditionally a slower mover. So if you see the dynamics change, that dollar is going to correct itself as well.
Yeah, absolutely, absolutely, and yeah. So no, Brand, I'm not showing the Dixie for trading purposes. I'm just showing it for example purposes of the dollar, which is how it should be looked at. The rest of it, witchcraft. You can have it. You know our thoughts of Dixie. That's it. That's the only time I'm showing a DXY this year. Okay, put that in stone, mate. And
I hope so.
if you see me doing it again, then pull me up,
Divorce.
please, please. Right. I wish you
The next showing of the Dixie is a case for divorce.
definitely. Anyway, that Bank of England decision has got everyone scrabbling around their forecast. UBS now expect the BOE to start cutting in June versus their prior forecast of August. Right, while we're on the dollar, this one made me laugh yesterday as well. Jobless claims coming in with a ridiculous 19k negative beat or miss of expectations. Okay, and the dollar dumped on this. It was crazy. Okay, let's look at it again. Context. Yes, it's the highest since I think last February. Where are we going? 231. So, there we go. November 2023 was the last time we had one higher than that. That was the largest number since February. So you're talking a few weeks. But we're still in this 200, 250 range. But yeah, the dollar took that as a negative sign, which is the mood we're in at the moment. With the buck, we said, been saying pretty much this week, it looks like the dollar's back in whack-a-mole mode, where any rally gets hit, or the market's really looking for excuse again, isn't it, to whack the dollar? And that was just a ridiculous thing to whack it on. I mean, continued claims still below 1.8 million.
Sorry, mate, go on.
No, go on. That was it.
Okay. Yeah, I think the dollar went into those numbers. The market went into those numbers a bit long dollars, and a bit, going into the Bank of England short cable, a bit long dollars, needing to buy it back. And then you go like, oh, right, if you can't be short sterling against the dollar, let's buy a couple of other dollars. And then you have these like little blip higher, and it was just, I think, people being a bit too long dollars at the minute, the short termers, and needing to buy back. And what I also think is that there's not too many long term or big flows in the market right now. I think those people are really sidelined or in positions, and just waiting for something next to really trade. The speculative positions may be showing decent positions, but I think the really long termers they are not doing that much, So this is again the reaction to a minor miss on a weekly number, which, as you say, has been hovering in this 200K range for an eternity. It's just an excuse to get some positions out of the market, and that's it. I'm not going to read much more in it. Overreaction for sure. But then at the same time, and today we're Friday, you scare probably away some of those shorter termers who have taken their 20, 30, 40 pips loss perhaps. And now they're out of the market on Friday because they don't want to risk it again. And then you have those bit of conspiracy theories starting to pop up here and there on social media, saying like, oh well, watch out! All the central banks are talking about FX. Something's coming. So yeah, it's all this combination that is holding now the dollar where we left it basically last night. Well, a little bit, just a tad versus some, maybe just a tad bit stronger again. But I don't think there's much reason to pick a side here, really, right here and now. And if you look at overall data, we're seeing green shoots elsewhere. But is it a reason to start building on dollar shorts? I'm really not sure.
Yeah, yeah, and there's several points you can take from this. There's people who will say, well, maybe this is the beginning of the jobs weakness.
Yeah,
Maybe it's the start.
absolutely.
It could absolutely be the start, but you're going to need more than
2023
that.
as well, huh?
Yeah, but you're going to need more than that to know there's a trend coming. If we're seeing numbers up near the 300,000 in jobless claims, if we're seeing continued claims getting over 1.9 million, heading to 2 million, okay, now you're seeing something. So it's going to be we've got enough time as traders to see a trend change in the jobless claims numbers because they're weekly. So we don't need to wait month after month. We can wait 4 weeks and we'll know if there's a trend developing, and we can move if we so wish. But what's also important, despite the ridiculousness of the reaction around this number, it's important to know that there was a reaction around this number because that might mean when we get lesser data, and we've got the Michigan coming up today, I believe. We've got the Michigan coming up today. I think we've got the Michigan coming up today. Yeah, so the flash numbers for the Michigan, it may be again that if we get a big day to miss or beat on these numbers, that we get a similar type reaction. So, we can all laugh about it and call it stupid, but it's important to know what the market did with that smaller number, which means it can do it with another smaller number. And that Michigan might be the number it does it on as well. So just keep that in the back of your mind when you get to these data points.
And also let's not forget it's those equity markets are flying, and usually that goes paired with a small weaker dollar. So there might have been a combination of algo or flows catching up on the back of those higher equities as well. But that's a global story. I mean, if you look at the DAX and the CAC, everything is flying. So
Yeah, exactly.
but yeah, I mean, and but today it's another, let's call it not major number like the Michigan could cause a bigger wave than what we usually may expect. So pay attention to that.
Yeah, exactly. Right. Speaking of flying, let me fly through the rest of the headlines, and we move on looking at some prices. So Fed's daily was out, expecting inflation to be a bumpy ride. Said the last 3 months has left considerable uncertainty about the next few months of inflation. She's getting different signals from firms who say consumers seem to be getting choosy, but input prices are not yet declining. Policy is restrictive, but it may still take some time to bring inflation down. Yellen proving that you can take the girl out of the central bank, but not the central bank out the girl. She says inflation has fallen substantially, but not enough for rate cuts yet. Over in Mexico, we had some CPI data out before the monetary policy news or announcement, and the data there was a little bit mixed. The core came down a bit, the headline went up a bit. So overall, that looked pretty neutral, and that indeed is how the Bank of Mexico saw it. They held their rate at 11% as expected, unanimous in that decision. So no dissenters there looking for anything else. And just reading through the statement, they're in steering mode, I think, is the best way to describe it. Kay, if they get a bit of weak data, they might cut a bit more. If they don't, they're gonna hold off. But they're certainly not in a rush to cut again. They're just gonna, as I say, shepherd it as the data tells them.
The Mexico governance is not specifically a dove. She will prefer to wait, and this was a mixed number. They actually revised CPI a bit higher for the course of 2024, so another bit of excuse to keep those yields where they are, because it was a little. There was like a small percentage chance that they actually make cut in sympathy with the rest of the Latin banks, but now they really show that they are independent from all of them. Yeah, not independent in the sense, right? Independent from a government, but independent as LATAM. They are not like the rest of the LATAM banks. They're leaning much closer to the US for obvious reasons. So yeah, they kept it, which means that we are still looking at an 11% currency. So when it came out, I just sold Euromex again, and there's I could have done Dollarmex. Dollarmex actually broke an interesting level around that 78.80, and Euromex is on it right now. We get below 1803.05, it can go for another run lower. Yeah, Dynamics is still half-heartedly trying to come off, but it's working on it. It's hard to combat an 11% currency, and that's the other side of the spectrum from the Japanese yen.
Yeah, the Dolomex isn't. It's been on obviously quite an incredible run, and even with this bounce, it came down quickly and broke a new low. It's not looking like it's as keen to have another look down towards those lows just yet. But it's got to do all the hard work again. We've got that big level, around the 1666 off these lows. That area, that's going to be a big area again if we test it. So done all the hard work previously, but it's got to do all that again if it does want to get back down towards those lows.
Yeah, it does look, if you look at that chart, whatever started to happen since July, September, especially of last year, like very fast spikes higher, and then you just drip lower again because it's hard to just be short mix for longer, and that's it. But let's not forget that in case we start to break below 16.5 again in dollar mix, don't forget that even the Labrador was complaining about the strength of the mix last time we were below there. So it can go another couple percent perhaps, but then I would really start to be careful again.
Yeah, no, very much so. And it's going the way it's going. So those carry traders aren't going to throw in the towel just yet.
No.
Right, well, anything got coming up? It's coming. We've got the Michigan, but we do have Canadian jobs. That's about the only other highlight on the calendar today for us, apart from some Fed wafflers, and we got quite a few of those: Bowman, Goolsbeast, and a couple of the others. But yeah, Canadian jobs will be our highlight today. Usual rules apply. Look at the headline number first. Then look at the unemployment rate, match it off against the participation rate, and then keep an eye on the wages as well. Additionally to that, we do have the usual revolving door to see where those jobs were gained or lost, part-time or full-time. You want to see, a strong jobs market is growth in full-time rather than growth in part-time, and vice versa. You want to see any losses in part-time while there's a gain in full-time. So that's coming up for you Loonie watchers. What you also need to be aware of for the Loonie, and I mentioned this last night as a reason why we're glued around this 136.80-90 zone, is that we have a ton of options expiring at that level today, over 3 billion expiring 136.80-90, and so far the range has been 72.90. So I think we're seeing a bit of options activity, keeping this one glued for want of any other reasons to trade at the moment. We're certainly not moving too much on oil right now, although we have seen a little bit of weakness. CAD gaining as oil's kept creeping higher.
Yeah, I just wanted to quickly say on gold, on oil, because Joao asked a question about inflation and oil. Yes, if oil goes higher, especially for importer countries, right? Like actually Europe is, and also Japan, of course. And higher energy is pushing up inflation, but it's also just costing more in cash to the different countries. And in the example of Japan, they don't like those higher import costs because it puts a bit of pressure on the local companies as well.
Yeah, very much so. But what I would counter with the oil argument is, don't think that a couple of bucks rally in oil is going to be significant for inflation. These sort of moves are significant for inflation. Sitting in a 20, 30 buck range for months is not going to have a big impact on inflation.
Well,
so even though we've seen this rally, 67s up to 88s. It's not a huge move for inflation, as you know, like you get when you get big spikes like that. And it tends to come, or has been coming down just as quickly as it's gone up. So yeah, and it also, you got to think it takes probably 3 to 6 months before you see the real effects of moves in any sort of commodity feeding through to inflation. So this rally that we saw, starting whenever early part of the year, well, maybe we're going to start seeing a bit of that feeding in, because it has to travel down all the way down the chain.
Yeah.
Obviously US gasoline prices is obviously a big watch for folks in the US.
Keep an eye on a simplistic, and it's not completely correct, okay, but keep it very simple and say like 10% moves will start to impact, and 10% moves on an asset will over time start to impact inflation. And so that is simplistic, because it's not true, because not completely. But if you have a 10% move, like we didn't have as much, but if you have a 10% move and you remain sticky up there, or down there, that will start to have an impact on your inflation. That's very simplistic, not completely right mathematically or so, or even economically, but it's a very easy one to remember.
Yeah, that's a very good tip for traders. Just like we say, looking at yields. You don't have to be a bond trader to just understand what yields mean for currencies and the like. Mr. Syed, can I look at gold? Yes, of course we can, sir. Look at gold, and looking quite strong again, it seems. I'm not sure what the driver is for this one at the moment. Kay, I don't know if you've got any thoughts, but we're back above this 2360s, which is a bit of an area. So go on, mate.
Yeah, I think the market is the Cairo talks have broken up, right? Israel went away without an agreement, so that's already something. But we were already trading above that 23.25 again, which I was always looking at. Well, 23, the whole zone basically, yeah, around 23, 20, 27. I've always been watching. And we kept below there for a while, and then trying to get back up there, and then actually last night it started to ramp higher, and it really didn't stop. So I think the Xi having finished, I think his European trip, perhaps not overly happy, and told his crew to hover some more in, because we woke up with a very strong world, and it's just continuing to go higher.
Yeah, while he was in France, maybe asked a few of his bods to nip across the border to Switzerland and fill their suitcases up for the trip home.
Yeah, maybe.
Decided to pick some up. But you don't think this is any sort of risk related move then? I mean, yeah, those talks have broken up, but it doesn't seem like we've been trading that for a while. Just the Israel situation. We were when it was Iran, making headlines, but
yeah, and then you have
Israel.
You have a bit of a combination, right? You have those talks breaking up, because that was the news yesterday, yeah? And then you have a bit of a lower yields environment everywhere. It's all helping, but we've also seen that this gold has been extremely resilient through whatever may have happened to it. I do see on my picture that move lower that we saw exactly a week ago held a broader channel nearly to the buck around 2280, and from there on we started to move higher again. I'm long my silver, but it's not. Of course, gold is a much bigger speculative or haven than silver ever will be. But yeah, so I haven't been riding this train, but it is a thorough move. The only thing I would say is that from the April highs down to that early May low, we are now bang on the 61.8%. For those who watch the FIBs, we are on the 61.8 here at 2373, so that may be a bit of a level. But if that goes in the afternoon, then you're talking about 2400 again.
Yeah, thank you, mate. And yeah, let us know, Said, what you're looking at in gold as well. You know, you're long, you're short, you're thinking it's going up, going down. You know, give us your thoughts as well. It's all right having our opinion, but we do like to hear from you as well. Right, Kate, time's clicking on, so I'm going to bet it over to you if you've got anything to show us.
Yep. You know what? I actually forgot that we have that we for a good reminder that we have the Canadian job report today. Yeah, let me quickly show just a couple of things. And I'm really going to. Oh yeah, I'm looking at the time. Going to keep it really short. Just an update. Silver held those low 26s and now creeping higher. I did let a slight slice go on the first move up here, but now we are trading back well above 28 bucks. That's encouraging. If we can just consolidate in this 28, 29 zone, I think it's going to be very constructive still to get a look back at that. I like to call it the roaring kitty high, the Reddit high that we saw around 30 bucks. I think it's very possible that we get up there, providing that all else remains equal. Yeah, quick look on the dollar CAD, and I'm going to really. I really confess that I forgot about those Canadian jobs. I may not have taken the position otherwise. I just bought a little here. I know it went through, but I was looking at this 136, 80s, 80, 90 zone. I said, if it has to hold, it may hold here. And then looking constructive for as long as we hold above 136, 35, 45 or so. I may just reduce the size of what I have on just to be on the safe side ahead of the labor report. For those who are new to our show, just as a reminder, when you look at the Canadian jobs report, you look at a couple of things, right? You look, of course, at the employment change, because that is what the main number is. Then you look at the unemployment rate combined with the participation rate, but do not forget to look at the balance between full and part-time employment, because that, if you get a move on the back of the headline change and the headline number, the full and part-time balance is usually what is going to give you the viability of the move. If you get a good employment number, but it's all part-time, the Canadian dollar will probably respond a bit positively at first, and then the market will turn around and say, like, well, okay, it may not be as strong as it filters through. If you get a good report and you get a good full-time increase and a lower part-time increase, that is actually a very good report. So the Canadian move can last for longer, okay? And vice versa, of course. So yeah, I think, but now we need to get back above 136.95 figure to start to get going again. If we get below 136, let's say 35.40, perhaps a bit of a hunt here for stops down to 135.90, 136 the figure, and then we need to reassess. As I said, I think this move was good enough to build a bit up on it, but that is why I caught that little knife here. But as we speak, I'm reducing the position right now ahead of the number. So we will see after the data. If we start to get back above 137 figure 10, then I think we can trade higher. But then we'll still have the Michigan afterwards. But anyway, this is how I look at it. Euro CAD relatively constructive, but we have to respect those highs here around up in the high 147s. Okay, if you want to trade it via cross. And then the MEX quickly after the Banxico, and I'm really going to only show the Euro MEX. We are on it. We are on the case. Low, a bit lower, and a bit lower. If we start to get below here, this 18, where roughly we are, 1805, 03, confirm it through 1797, then I think we are on our way back to a bit lower levels. Again, if this confirms, okay, again, keep an eye on that dollar mix, as I said, because if it gets below 16.5, if the driver is the dollar mix rather than the combination of the dollar mix and the euro dollar, If the driver is solely the dollar mex, keep an eye on that 16.5 and whatever happens below. If we get any comments from the Mexican officials. Cavi Platinum, I am not looking on Platinum. Yeah, thanks, Angela. I don't know, Ryan, if you want to look at Platinum, but I'm not looking at it at all.
I don't think I've even got it on my list.
No, me neither. I know, but we can't look at everything. I've got about 75 currency pairs or so that I'm looking at, and including oil and gold and silver, but we can't do everything. I'm sorry. Alrighty, back over to you, Ryan, and have a great weekend, everybody.
Yeah, thank you very much, mate, for that. Yeah, Cavi, you can also, I believe you're in our chat room, so yeah, put your question in there. Someone might have something for you, maybe Mark, MRBH. He likes to look at platinum now again, so yeah, check it up in the chat room, and we'll take it from there. Oh, what a week it's been again. And we do it all again next week as well. Thank you, as always, for coming and supporting us here at the Flow Show. Do check out our chat room. You know, you saw Simon having a laugh there. It's not all business. We do like to have a little bit of fun and to get through the day. And, you know, we'll do it with a good humour. It's a good community to sit in when you're sitting at home alone. No one else to talk to but 8 screens. So come and check us out in the community. You can try it $1 for 10 days. You know the link, ForexAnalytix.com. Apart from that, have a great weekend, everybody. Thank you, K-Man, as always, and we shall see you next week.